All right, so today we're going to be diving into, this whole idea of like ETFs, right? And like everyone's talking about ETFs these days.
Yeah.
But we're going to be looking at a Motley Fool article that kind of gives an interesting perspective on this whole thing. So have you heard of Warren Buffett?
Yeah, of course, the Oracle of Omaha.
Yeah, exactly. So he's known for like picking stocks, right?
Yeah.
Like that's kind of his whole thing is like meticulously going through companies and like figuring out which ones are going to do well over the long term.
Yeah, value investing.
Yeah, exactly. But here's the interesting thing. He also owns an ETF.
Oh, really?
Yeah.
I knew that.
Yeah, the Vanguard S&P 500 ETF. So ticker symbol VOO. And that's kind of like the big takeaway here is that like even someone like Warren Buffett, right,
Yeah.
who's like the stock picker extraordinaire, still sees value in like a simple broad market ETF.
So it's not just for beginners then?
Exactly. It's not just like a stepping stone. It's like a legitimate part of like a sophisticated portfolio.
That's really interesting because, a lot of people think of ETFs as just like the starter thing before you get to the real deal of picking individual stocks.
Right.
But if Buffett's doing it, that kind of changes things.
Totally. Yeah. And I think it speaks to like the power of diversification,
Yeah.
right? Because like with an ETF like the S&P 500, you're getting like a slice of like 500 of the largest U.S. companies.
Yeah. You're not putting all your eggs in one basket.
Exactly. And I think that's like one of the key principles that he's always emphasized is like, don't bet everything on one company or one sector. Spread your risk. And like that's what an ETF like VOO allows you to do.
So what's his rationale for specifically choosing Vanguard?
Well, that's actually something that he's talked about publicly. Back in 2013, he wrote this letter to Berkshire Hathaway shareholders. And he actually specifically called out Vanguard funds.
What did he say?
So basically, he said that they perform very similarly to like State Street's S&P 500 ETFs. But Vanguard has consistently lower expense ratios.
Oh, so he's being frugal even with his billions.
Yeah. Exactly. Like he's all about like minimizing costs. And, those expense ratios, they might seem small, but over time, they can really eat into your returns.
Yeah, absolutely. Those tiny percentages compound over decades.
And it's thousands of dollars lost.
Yeah, money that could have been in your pocket.
Exactly. And so it's like even someone like Buffett, right, who's at the top of the game,
Yeah.
is still like sweating the small stuff.
Mhm.
Like he's not just throwing money around. He's thinking about every little detail.
And I guess that's part of what makes him so successful.
Exactly. It's a good lesson for all of us. Now, here's where things get kind of interesting. This Motley Fool article also features this guy, Barry Bannister. He's the chief equity strategist at Stifel.
Okay.
And he's actually predicting like a 26% plunge in the S&P 500 in 2025.
Wow, that's a pretty bold prediction.
Yeah, 26%.
That's a significant drop.
That's a lot.
So why is he so bearish? What's his reasoning?
Well, he uses this term effervescent to describe the current market.
Effervescent. What's he mean by that?
So basically, he's saying that there's like a lot of hype, like there's this momentum pushing prices up, but it's not necessarily based on like actual economic reality.
So it's like a bubble that's about to burst?
Kind of, yeah.
Yeah.
And he's worried about a couple of things. One is valuations.
Okay, so like whether stock prices are justified by the earnings of the companies.
Exactly. And he believes they might be inflated right now. And then the other thing he's concerned about is just like broader macroeconomic conditions.
So like a potential economic slowdown.
Right. We're seeing some signals of that. And that always has an impact on the stock market.
Yeah, if the economy slows down, companies make less money.
Right.
And their stock prices tend to go down.
Exactly. And it's not just Bannister who's sounding the alarm bells here. The article also mentions like warnings from other experts, like Morgan Stanley's chief global economist, Seth Carpenter. He's particularly concerned about President-elect Trump's proposed tariffs.
Yes, the tariff.
Yeah, so the idea is that those tariffs could have like this ripple effect throughout the economy, leading to higher prices for consumers, which then like affects corporate profits.
And ultimately stock prices.
Exactly. It's all connected.
It's like a delicate ecosystem.
Yeah, and what's fascinating is that the S&P 500 itself often acts as like a leading indicator.
Oh, really?
Yeah, it starts to reflect these economic shifts, sometimes even before the actual data comes out.
It's like the market has a sixth sense or something.
Right, it's trying to anticipate what's coming down the road.
So we've got this tug of war going on between potential growth and these looming risks. And the question is, what does it all mean for investors? Like, what do we do with this information?
Yeah, that's the million-dollar question, right?
Yeah.
And that's what we're going to be exploring in the next part of our deep dive, so stay tuned.
I think the big thing here is, like, not getting too caught up in the short-term stuff. You know, like everyone's always talking about like what's the market going to do tomorrow or next week or in 2025 in this case.
Yeah, it's easy to get caught up in the headlines, right?
Totally. But if you're like constantly reacting to every little thing, you're probably going to miss the bigger picture.
Like zooming out is important.
Yeah, think of it this way. The stock market's like a giant ocean, right?
Yeah.
On the surface, you've got like waves crashing and storms brewing, all this volatility. But deep down, there are these powerful currents moving things in a general direction over time.
I like that analogy.
Yeah. So even if like this analyst's prediction comes true and the S&P 500 takes a dip in 2025, it doesn't necessarily mean that like long-term investors should panic.
Especially those holding VOO.
Exactly. Yeah. Because remember, VOO is inherently diversified.
It's 500 companies.
Yeah, 500 companies across all these different sectors. So even if some are struggling, others are likely doing well, and it kind of smooths out the overall performance.
And if you're investing consistently over time, those dips can actually be a good thing, right?
Oh, absolutely. You're buying more shares at a lower price.
Dollar cost averaging. But I think some people listening might be thinking, well, that's great for long-term investors. But what about me? What if I have like a shorter time horizon? Or I'm just like more risk averse?
Yeah, that's a totally valid concern. And it really highlights the importance of like understanding your own individual circumstances.
Right. There's no one-size-fits-all approach.
Exactly. And I think the key takeaway here is that you should consider these expert predictions, but not as like gospel truth.
They're just one piece of the puzzle.
Right. They provide context, but they shouldn't dictate your entire strategy.
So how do we balance like those external opinions with our own internal needs and risk tolerance?
Well, first off, I think it's essential to review your asset allocation.
Like how your money's distributed across different asset classes.
Exactly. So like stocks, bonds, real estate, all that stuff. If you're heavily weighted towards stocks and you're worried about a downturn, you might consider shifting a portion to more conservative assets, like bonds.
Okay, because they tend to be less volatile.
Exactly. They can provide a buffer during market swings.
Makes sense. But even with a diversified portfolio, some folks might still be feeling uneasy.
Yeah.
Given this prediction of a 26% drop.
Yeah, I get that.
So is there anything else they can do to prepare?
Absolutely. This is where that emergency fund comes into play.
Ah, the good old emergency fund.
It's not just for like a rainy day, it's for market storms too.
I like that.
Having that cash readily available prevents you from being forced to sell investments at a loss if something unexpected comes up.
Right, it's like a financial safety net.
Exactly. Gives you peace of mind. And the flexibility to ride out those dips without making rash decisions.
So we've covered a lot of ground here,
Yeah.
but I think the main takeaway is that while expert predictions can be informative, they shouldn't be the sole driver of our actions.
I completely agree. And remember, even Warren Buffett, despite his incredible track record, doesn't always get it right.
He's human.
Yeah, he's emphasized that investing is about understanding your goals, managing risk, and making informed decisions.
And he's also like a huge advocate for value investing, right?
Yes, absolutely.
Obviously, he applies that on a massive scale. But are there any principles from that approach that like everyday investors can use?
Definitely. Value investing is all about identifying companies that are undervalued by the market. So it involves researching companies, looking for strong fundamentals, good management, a consistent history of profitability.
So it's not just about chasing the latest hot stock.
No, it's about finding those hidden gems that have long-term potential.
But for those of us who don't have the time or expertise to dig deep into individual companies, can we apply those principles to ETF selection as well?
Absolutely. Don't just blindly choose any S&P 500 ETF. Research different funds, compare their expense ratios, look at the specific companies they hold, and see if their investment philosophy aligns with your own values.
So even with ETFs, it's important to be an engaged investor.
Absolutely. It can make a big difference over time.
Now, before we wrap up this part of our deep dive, I want to circle back to something we talked about earlier, the potential impact of political policies on the market.
Right. The article mentioned how deregulation and tax cuts under a second Trump administration could potentially boost the market.
But as with all things political, there's always the other side of the coin.
Of course.
What happens if those policies don't have the intended effect? Or what if a future administration reverses course?
That's a valid concern, and it reinforces the need for both diversification and a long-term perspective.
Because even if specific political decisions don't play out as predicted, history shows that the market tends to find its way forward.
Over time, yes.
It goes back to that ocean analogy.
Right, the storms might rage on the surface, but the underlying current eventually prevails.
So how do we, as individual investors, navigate these potentially choppy waters?
By staying informed, staying focused on our goals, and remembering that even legendary investors like Warren Buffett don't have a crystal ball.
And that even he sees the value in ETFs. This conversation has been really insightful, and I think it's given our listeners a lot to think about. But before we wrap up completely, let's turn our attention back to those expert predictions. How much weight should we really give them? Yeah, it's like we want to believe them, right?
Yeah, they have all the data.
Yeah, access to research.
Oh, easy titles.
But then you see like how often they get things wrong.
I know, it can be so frustrating.
Yeah, like are they even worth listening to?
Well, I think it's more nuanced than that.
Okay.
Like no one has a perfect track record.
Right, not even Buffett.
Even Buffett.
Yeah.
They're making educated guesses.
But still guesses.
Yeah, based on the best available information.
So it's more about probabilities.
It's exactly.
Not like a sure thing.
You're not a crystal ball.
More like a weather forecast.
Oh, I like that.
Like there's always a chance of rain.
Right, even if it's sunny.
So we need to like consider the source.
Absolutely.
Like who is this analyst?
Yeah, what's their track record?
Are they always doom and gloom?
Right, some people just have like a permanently bearish outlook.
Yeah, so we can't just take their word for it.
No, we got to look at the why.
The why.
Yeah, like what's the logic behind their prediction?
Does it make sense?
Exactly, and does it align with your own understanding of the market?
Because if it doesn't.
Red flag.
Right, and I think another thing to keep in mind is a lot of these predictions are short-term focused.
Oh yeah, that they're trying to call the next few months.
Oh, the next year.
But as long-term investors, we're playing a different game. We're building for the future.
Not trying to time the market.
Exactly. So those short-term predictions, well, interesting, shouldn't really drive our decisions.
They need to be filtered.
Yeah, through the lens of our own goals and timeline.
Because for someone investing for retirement,
decades from now,
a market dip might not even matter.
Might even be an opportunity.
Dollar cost averaging.
Buy low.
But for someone saving for a down payment,
next year,
that same dip could be a problem.
Big problem.
So context is key. How do we avoid getting swept up in all this noise?
Have a plan.
A plan.
An investment plan.
Like a roadmap.
Yeah, like a compass in a storm.
It keeps you on course.
Through the ups and downs.
And that plan should be based on
your risk tolerance.
Your time horizon.
Your goal.
Not on what some analysts said.
Exactly. And remember, even the best investors make mistakes.
Buffett included.
Yeah, he's talked about his blunders.
It's not about being perfect.
It's about being consistent.
And disciplined.
And staying focused on the long game.
So as we wrap up this deep dive, here's a challenge for our listeners.
Yeah.
How can you use what we've talked about today to become a more informed investor?
A more confident investor.
Build a portfolio that reflects your goals.
Your values.
Because the more you know,
the better equipped you'll be
to navigate the market.
And achieve your financial dreams.
That's what the deep dive is all about. Empowering you with information.
To make smarter decisions.
And live a richer life. Thanks for joining us.